Kathryn, so first of all, the Fed meeting. Clearly, we have overwhelming expectations the Fed's going to cut rates. The big question is, has the market already figured that out and priced it, and how might it react to the various ways the Fed might characterize such a move?
Yeah, that characterization is critical, right? Because the market is pricing in way more than I think they're going to actually deliver. Between 3 to 5 cuts in an environment of full employment, above potential, above trend economic growth, and record high equity markets seems way beyond what the Fed is likely to deliver, in which case one has to ask oneself, what will the reaction be in the markets? And I think that's going to be to the downside, and that's why I'm recommending put options on guys who are ready to forfeit 3.5% of their return year to date for a put expiry in December. So I think that's a good call. Another call is, look, if I'm right and they do a one and done, if they do 125 basis point cut, or they do 50, but they don't do 3 to 5 25 basis point cuts, then I think it would be actually a good time to get in when you do see that retracement in markets.
So if you say it's sensible right now, perhaps, to spend around 3.5% of a stock portfolio to protect against that downside, that means you expect more than 3.5% downside, right? I mean, what kind of event do you think this might be?
Correct. Yeah, sure. I mean, look, if we get a repricing in the markets where guys start talking about, instead of 3 to 5, 1 to 2, I think you're going to get 5%. And if, in fact, we get a hard Brexit, we're going to get a lot more than that. So I think protecting your portfolio right now is a very smart thing to do. Looking for opportunities, which I think will come about to re-enter or to accumulate in the fourth quarter of this year.
Kathryn, can we talk a bit about the earnings season? I mean, the question is, you know, we're looking at the equity markets at record high levels. There's some question about the economic outlook, certainly globally. And, you know, what we're looking from the earnings numbers is to sort of, is there nervousness that we should be worried about equity prices because the earnings can't support, or the earnings outlook? How are you seeing these earnings coming in? And does that give you confidence that in the longer run after this correction, we can continue to see equity markets move higher?
Sure. There's 3 things that we've heard repeatedly in the media and with investors, me talking to institutional clients, et cetera, over the past, let's call it 6 to 10 months. So 1 is U.S. recession, 2 is earnings recession, and 3 is trade war. So right now we're looking at an environment where none of those are coming to fruition, and that's been my call since the beginning of the year. That's why we've had a forecast on the S&P to near 3,000 for the end of this year. So earnings have not seen that expected recession. In fact, if you compare to 2Q of last year, year over year, earnings are posting an extraordinary expansion, given that 2Q of 2018's earnings growth was about 25% year over year. So we're at, 3.5%, 4% at the moment. I think earnings growth are very strong. And if, in fact, we get one cut, that is a boost to economic growth, to earnings, and I think it's net positive for the U.S. economy. So no recession. I don't think a trade war is going to accelerate or get worse before the 2020 election. And I do think that earnings growth are going to continue to come in solid. So all of that is positive. What I think the market's going to have to reprice is the extent, the magnitude, and the velocity of Fed cuts.
Yeah, as we sit here with the S&P around 30.25, so right around your target. Kathryn, thank you very much.